Ignoring the signal that just triggered this crypto meltdown could leave you completely blindsided in the next market cycle. While everyone's blaming the usual fear and doubt, the real trigger was a quiet announcement from the Bank of Japan that almost no one saw coming. By the end of this explainer, you're going to understand the 5 hidden forces behind this crash and see the 2 completely different paths the market could take from here. Okay, let's get right into the numbers. We're talking about a $5,000 drop in Bitcoin's value in just 24 hours. I mean, this wasn't some slow bleed, it was a brutal, fast-moving shockwave that caught pretty much everyone off guard. And it wasn't just retail investors feeling that pain. Even seasoned analysts were just left stunned. This quote from the 99 Bitcoins channel, it really captures that collective gasp across the market, just pure shock. So, how do we make sense of all this chaos? Well, we're going to break it down into 5 key parts. First, we'll look at the initial shock. Then, we're going to dissect the mechanics of the crash itself. After that, we'll uncover the hidden trigger that most people missed. We'll look at the perfect storm of fear that made the damage so much worse. And finally, we'll explore the 2 very different paths the market could take from here. All right, so let's start with the hard data of the meltdown itself. Now, this slide, it really puts the crash into a broader context. See, this wasn't just a 24-hour event. Bitcoin is now down a staggering 36% from its recent all-time high of around $73,000. And it wasn't just Bitcoin. Ethereum also took a major hit, losing hundreds of dollars and wiping out all its recent gains in an instant. But that brings up a really critical question. Why was the crash so fast and so violent? The answer isn't just about bad sentiment. It's deep inside the market's own plumbing. To really get what happened next, you have to know about one key concept: leverage. Just think of it as trading with borrowed money. It lets you make much bigger bets, which, hey, is fantastic when prices are going up, but it can be absolutely devastating when they fall. And when the market suddenly turned, that leverage became a weapon of mass destruction. It created this tidal wave of forced selling, with over $500 million in these leveraged positions being automatically closed out or liquidated in a very, very short period. And this is where we see that domino effect in action. It all started with just one large sell order hitting the market at the worst possible time, late on a Sunday night when trading volume is super low. That initial drop triggered automated liquidations. Of course, those liquidations created even more selling pressure, pushing the price down and triggering another wave of liquidations. It's a vicious, accelerating cycle, something we call a liquidation cascade. So, if leverage was the gasoline poured all over the market, what was the match that lit the fire? Well, it turns out it was a surprising global event that almost no one in crypto was even watching. So, what was that trigger? It wasn't the typical crypto news you might expect, right? Not a regulatory crackdown or some big exchange hack. No, the real catalyst came from halfway around the world, from the world of traditional finance. The main culprit was the unwinding of something called the Japanese yen carry trade. See, for years, global investors have borrowed Japanese yen at basically zero interest and used that cheap money to buy riskier, higher-yielding assets. You guessed it, like crypto. But on December 1st, everything changed. The Bank of Japan signaled it was finally going to raise interest rates. And just like that, the free money spigot got turned off. Investors had to scramble to sell their crypto to get cash to pay back their now more expensive yen loans, and that triggered a massive wave of selling that hit the market hard. So you have this huge macroeconomic shock. And then it collides with a perfect storm of fear, uncertainty, and doubt, what we call FUD, that was already swirling around in the crypto space. And that turned a bad situation into an absolute disaster. This is where the fear really took over. You had a combination of 3 major narratives all hitting at once. First, old news about China's crypto ban resurfaced, a reliable scare tactic, even though China is still a massive mining hub. Then, a misunderstanding of a MicroStrategy filing made people freak out that Michael Saylor was dumping his Bitcoin, which he wasn't. And finally, those perennial fears about Tether's reserves popped up again. Each of these alone is really just noise, but together, they created maximum panic. So, with all these forces in play, the big question is, where does the market go from here? Our sources are pointing to 2 very different possibilities. On one hand, you've got the bearish technical view, which comes mainly from 99 Bitcoins. They point out that Bitcoin has fallen below a key technical indicator, the 50-week moving average, and that could signal a prolonged downturn, potentially seeing prices fall into that $45,000 to $65,000 range. But on the other hand, the analysis from Crypto Global News frames this as a necessary shakeout. They argue this macro-driven panic is just flushing out the weak hands before the next major move up, with a possible short-term dip to the low 80,000s before a powerful reversal. And this all leads us to a final, and I think critical, question. As crypto matures, is it still its own self-contained world? Or, as this crash seems to suggest, is it now just a pawn in a much larger global game? The answer to that question could define everything in the next cycle.
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.